Hey, what's going on, everybody? Welcome back to the Land Development Podcast. I am your host, Ryan Glick, and we have an industry news episode for you today. That's where we pull up three different headlines. We talk about what it means for the industry. Other times when you tune in, you're going to hear an interview style episode, and that's where we have on somebody associated with the industry, with the land development industry. And we hear about their origin story and then also about some of the projects that they have going on. And as always, on these industry news episodes, I have with me Charles Covey. Charles, how's it going?
Hey, good to be here.
All right. And we are mixing it up a little bit with our visual display for those of you who are watching on YouTube. Rather than scrolling endlessly through all these different articles, we've decided to cut out some of the key points that we're going to talk about on here and dig into them. So you'll kind of see a little bit different visual as we go through today's episode. And yeah, share your feedback on this. If you like this better than the other way we were doing it, love to hear your thoughts as we continue to move forward. So with that said, let's go ahead and jump into the first article. And the first article comes to us from Market Watch. The headline reads, "A record 60,000 home buyers backed out of deals in July. Here's why." So reading from the article, a record number of home buyers backed out of deals in July despite falling mortgage rates, according to a new report. About 59,000 home purchase agreements were canceled in July, real estate brokerage Redfin said on Monday, which is about 16% of homes that went under contract that month. That's the highest share of cancellations for any July on record, going back to 2017 when the company began tracking that data. Cancellations were the highest in markets where home builders have been active, and the inventory of new homes has risen considerably. The three metro areas with the highest share of canceled home buying deals were Tampa, Florida, Fort Lauderdale, Florida, and San Antonio, Texas, Redfin said. A lack of interest from buyers, as well as a glut of supply in some local real estate markets, has also pushed some sellers to cut the price of their home listings. Redfin said that the total number of homes for sale in July was up nearly 14% in July compared with the same time a year ago. So when I saw this article, I thought it was interesting to see, what were some of those reasons that people were canceling. I know I didn't show it here on the screen, but one of the sub headlines of this article was mentioning that the political climate is one of the big reasons that individuals have cited as being one of the main reasons that they've canceled. Obviously being an election year, and here we are in August, and not too far away from the November elections, presidential elections, and everything. So I thought that was interesting that came out of this article. What are your thoughts on what we're seeing here with a lot of these cancellations happening? Does this surprise you at all?
It doesn't, only because I was just studying this data this week, and the data of election years and post-election years is really fascinating. So the 6 months leading up to an election is generally pretty cool in the economy. Homes are no exception to that. So it tends to cool. Home sales go down in the 6 months leading up to an election, and then very consistently they pick up both in volume and in price post-election. So this was pretty cool to see. I don't think it's a thing that the market needs to be terribly concerned about. It should be somewhat expected, and we're seeing this in other, some of our acquisition work. We're seeing businesses kind of trend down a little bit year over year this year, and a lot of that is being placed on just kind of general coolness of the market. People just pausing on growth, pausing on a lot of things that they might normally be spending money on in the business sector. So I'm assuming that trickles down to consumers as well. And we'll see how this plays out. But for the majority of the elections in the last, eight or 10 cycles, we've always seen things trend down towards the election and then trend up post-election, which is fascinating because if you think about, people now would say, oh, well, if this candidate gets elected, the world's going to go to crap. Well, no. But if this other one gets elected, it's totally going to go to crap. And I think that the information we've seen in the past is that is generally the thought process that happens before every election. But then actually what happens after the election is not that way. And the world still keeps moving, and businesses operate, and people make money, and people spend money. So that's probably going to be the case this time. People will still elect to spend money post-election as they always do. So fascinating to watch this play out. It looks like we're kind of tracking as would be expected in an election year.
Yeah, and I think another thing just to note in here too is that it talks about, specifically on this this slide right here that we're looking at, home builders have been active. So it's talking about these cancellations were highest in markets. So where home builders have been active, meaning that, a majority of these cancellations have been on new construction. And, you know, what, because you're likely not going to have a lot of people at this point in time change their mindset around listing their existing home if they're sitting on a very comfortable mortgage, or maybe they own the house outright, and so not wanting to quite get into the market yet. So anyway, yeah, it is interesting to see how this is going to go and whether this spreads out and starts to impact other areas once rates come down. But I would imagine as rates continue to come down, we're going to see less of this and everything. And so, yeah, again, as we've been talking about for the last few episodes, we're in a very interesting time right now, and we're seeing a similar pattern to what we've seen in prior election cycles. But there's also a lot of other stuff going on that we haven't necessarily seen at the same time as other political cycles and all of that. So yeah, it's going to be interesting to watch this and see how this continues to change, or if we get less people with these types of cancellations.
Yeah, Ryan, just adding to that, we touched on this a little bit earlier, kind of before the call. Is an interesting point here. I think most of us would agree that correction was needed in the market, right? A lot of real estate was inflated, and you look at any graph, you're like, wait a minute, the prices right now are way above where the trend line should be. Okay, so that means most likely that there's a correction needed or incoming. So I think you've got a couple of factors here. You've got buyers are perceiving that, hey, rates are almost certainly going to go down later versus today. Almost certainly, I think there's probably the market is priced in probably a 70% chance that rates go down 0.5% at this next meeting. Okay, so if you're buying a house and you can wait a couple of months and get a 0.5% difference, that's probably notable in your monthly payment. That probably matters. And so I think that's kind of becoming a realization. Additionally, you've also got people realizing, okay, corrections are happening. We are seeing a difference and you notice in the data here, we're seeing reductions in prices. Almost 25% of the homes listed on one of the platforms that it listed earlier, almost 25% had received a correction in the last 30 or 60 days. Okay, so that means the market is correcting. We don't see all the homes just flying off at above asking. We're definitely seeing asking come down, and that trend is notable. I think buyers are picking up on that. We're seeing that in the land market as well. We're seeing a closing of the gap between the bid ask price, and that's been an issue for the last year or two. It's been challenging. I think we're starting to see some of that cool a little bit. That'll of course trickle into lower prices in new homes potentially if we continue to see that trend continue. So buyers are starting to pick up on the fact that things are potentially correcting, and they're willing to wait in order to see what the market does.
Yep. No, good point. All right. Well, let's go ahead and move on to the second article. This one comes to us from the National Association of Home Builders. So we've talked a lot on the show about the CPI and what the inflation rate looks like. And so this one felt like an interesting one to pull up and talk through. So the headline reads, "Inflation falls below 3% amid persistent housing costs." So reading from this article, inflation dropped below a 3% annualized growth rate for the first time since March 2021, even though housing costs continue to climb. Nonetheless, the headline reading is another dovish signal for future monetary policy, following signs of weakness in the most recent job report. Despite a slowdown in the year-over-year increase, shelter costs continue to exert significant upward pressure on inflation, contributing nearly 90% of the monthly increase in overall inflation and more than 70% of the total 12-month increase in core inflation, as consistent disinflation and a cooling labor market bring the economy into better balance. The Federal Reserve is likely to further solidify behind the case for rate cuts, which could help ease some pressure on the housing market. So last one here, the Fed's ability to address rising housing costs is limited because increases are driven by a lack of affordable supply and increasing development costs. Additional housing supply is the primary solution to tame housing inflation. However, the Fed's tools for promoting housing supply are constrained. In fact, further tightening of monetary policy would hurt housing supply because it would increase the cost of A, D, and C financing. So looking at the graph here, so we kind of see how these trend lines have gone over time with the CPI, with all items, and then also CPI specific to shelter. So we can see the all items has gone down as of July 24th below 3%. And then the shelter is still up at 5.1%. So what are your thoughts on this, Charles?
Well, I've been saying I feel like a broken record. The CPI is crap. They need a new metric. They need to be able to measure this stuff more effectively, more accurately, more up to date. But, me complaining about it's not going to change it, apparently. So we just talk to our congressman and see if something can happen. Good luck.
Yeah.
But at this point, you can definitely see that things are changing and that number is coming down into a place where the Fed could be more comfortable with dropping rates just based on what they said they wanted. What's really notable there is how this thing really kind of gets into a vicious cycle. So that article noted at the end, and this is a very good point, something that we're all feeling in the development space, is that they're trying to decrease this inflationary scenario by increasing rates. Well, now they've made it harder for developers to develop because now deals don't pencil because rates are too high. And so now you've got what's going to happen in the next 12 to 24 and 36 months. You're going to see a massive decline in projects delivering, especially in the multifamily and build to rent sectors. And those prices are going to go up. And that's going to negatively affect this thing again. So that cycle is feeding itself, and it's kind of vicious. And that's a problem to solve. My personal thought is that we need a housing czar, or we need some other type of overarching national position, somebody that can, we did it with Homeland Security. We created these other positions for other things that became very problematic. I think housing is a big enough issue. We need a housing czar. We need that position in DC to really focus on relationships at a state level and to really enact things that can make a bigger impact. Right now, this is what we've got. The best that the Fed can do is just, hope and pray that they don't overcorrect here. Looks like the rates coming down will allow more deals to get back into the pipeline. So hopefully we don't have too big of a shortage issue in rental units in 24 months.
Yeah. So we'll continue to keep an eye on this as we go forward. We're just a few weeks away here from the Fed's next meeting, so we'll see what's going to happen with rate cuts here very soon. All right. Well, let's move on to the third and final headline here. This article comes to us from CNBC, and the headline reads, "Mortgage refinancing surges 35% in 1 week as interest rates hit lowest level in over a year." So reading from this article, applications to refinance a home loan surged 35% last week compared with the previous week, according to the Mortgage Bankers Association's seasonally adjusted index. They were up a whopping 118% when compared with the same week 1 year ago. This, even though the average contract interest rate for 30-year fixed rate mortgages with conforming loan balances, which are defined here as $766,550 or less, fell very slightly to 6.54% from 6.55%, with points decreasing to 0.57 from 0.58, including the origination fee for loans with a 20% down payment. While rates dropped just 1 basis point last week, they were down 33 basis points in the past 4 weeks. They were also 62 basis points lower than the same week a year ago. The refinance index also saw its strongest week since May 2022, driven by gains in conventional, FHA, and VA applications, said Joel Kahn, an MBA economist, in a release. And let's see here, last one. The refinance share of mortgage activity increased to 48.6% of total applications from 41.7% in the previous week. 1 year ago, refinance volume was just 29% of total applications. So when I see this article, I guess my initial reaction or initial thought of why this stood out to me was, is this a potential signal for what consumers are thinking right now? So, if we're starting to see an increase in refinance activity, you obviously have, some homeowners who got into their mortgages at higher rates, at least a high enough rate to make this, worthwhile for them. But does this also signal that consumers are getting closer to being comfortable to start, taking out new mortgages for homes, as rates start to come down? And I obviously we're going to see how that plays out, but refinance volume, I'm not sure if this has been a signal historically, but it sure is interesting to see that 1 year ago refinance applications were just 29% of all loan activity and everything, versus today it's almost, we're almost up to 50-50 between new homes and refinance activity. What are your thoughts on this, Charles?
Well, I can imagine if you specialize in refinancing homes, the last 2 years have been pretty dismal. It's been pretty lean, and those guys have been struggling. So it's good to see some refinances coming back into play. It's going to be, you're going to need to have at least a half a point to make any sense in refinancing. Really, 1 point is going to make a lot more sense. So if you look at this, there were some people that got homes at 7.5 or 8%, in the last 24 months. So if that's the case, now you're down in, mid sixes. That's notable. Okay, you could get a point off of your, or maybe even a little more off your loan. That makes sense. You're going to want to refinance that. So it may not be a huge difference, but it could be several $100s a month. That could be notable for you, and make sense to do so. We're going to continue to see that. I don't think this is enough of an indication that we're going to see a bunch of existing inventory, existing homes. I don't think we're going to start seeing those turn yet. I don't think it's quite there. If you think about how this will go, just kind of relating back to the info that we talked about earlier in the episode, we typically see a surge in sales in the post-election year. So I think with rates doing what they're going to do, plus that extra surge post-election, I think we're going to see a lot of existing homes turn over. That pent-up demand is going to happen next year, maybe spring to summer of next year. Think about all the different things at play here. It's going to be fascinating. You've got all this stuff that happened with real estate agents and, their abilities to charge, or the ways that they can require certain fees and their commissions to be in the contract, not in the contract, on MLS, not on MLS. And the way that's going to play out, you got some pretty hungry real estate agents right now because homes are not selling. And unless they've got a deal with a builder where they're selling new homes, the existing inventory is pretty slow. So then you get next year, you get, a bunch of hungry real estate agents, and you get a bunch of existing inventory that's turning over because people have decided it's time for us to do that new home move up, or that larger home move up we didn't do for the last 2 years. Now everybody's going to be fighting and negotiating commissions down. It's going to be a total free for all. It's going to be the Wild West. So that's going to be pretty interesting to see that play out. I'm just fascinated by that whole thing. So it is going to happen post-election next year. We'll be following it. It's going to be pretty cool to watch. I think it's going to be a lot of movement in the market.
Yeah. Do you think, and I've never seen any data on this, but do you think that consumers, so let's say existing homeowners who have an existing mortgage, maybe at a lower percent, like somewhere around 3, versus somebody who's coming into the market maybe for the first time to buy a home, do you think that their perception of rates are going to be completely different, and they'll make moves at different times? Meaning, like, just because rates are coming down, it may mean that we're going to start to see more new construction sell, but a lot of the existing homes are still not going to be on the market because existing homeowners who are locked into some lower rates are still not going to be, interested. Because I would imagine your mindset, if you've lived through something and you've experienced something, I think it feel like it's going to take a lot more time for you to be comfortable with the quote unquote new normal of whatever rates are going to maybe even off at and everything. So I'm just curious what your thoughts are on that.
Yeah, you're absolutely correct. I think that's going to play out. So you've got somebody sitting at a 3% rate, and there's a bunch of them. Below 3.5 is like a ton. So it's got to be probably in the 4s, at least in the low 5s, high 4s, before they're really interested in moving. And because of that, they're probably sitting. Well, then you've got all these people that, as it drops towards the upper 5s, maybe low 6s, upper 5s, well, it's time for us to get a house. Like, we've been waiting, we've been in an apartment, we've been sharing with the family or whatever. It's time for us to make a move. But yet there's no new homes, there's no existing inventory that's moving because they don't want to move out. And so it's going to be a really good time for builders. I think next year could be really exciting for builders. Later in the year, as we start to see that maybe end of 25, early 26, I think that's when you see that pent up demand happen on the existing home side. But you're going to see the pent up demand come into play first on the new homes, because that's going to be all that's available. And that's what's going to be moving for those that are like, hey, it's time for us to do something and get into a home, especially those that aren't moving out of a really low rate mortgage.
Yep. Okay. No, that makes sense, and that's kind of in sync with where my head was at. Being someone myself, that's in a very low interest rate. I my wife and I had conversations about, hey, do we want to look for something different? And obviously, we chose not to, and we chose to, make some improvements on our existing home versus going out and doing that. So I imagine there's a lot of people who are in that spot, and if they did make improvements on their existing, home, maybe they're going to be sitting good there for a little while because they did the things that they wanted to do as well. So
Yep.
yeah, I'm just super interested in seeing how that existing inventory finds its way onto the market and up for sale. Like, what has to happen? Is it rates? Is it going to be more than that? Because the rate alone is not going to, if people did do some home improvements and stuff, maybe the rate alone's not, they're just not interested anymore in selling their home because they're happy and content with where they're sitting. So yeah, it's going to be interesting to see how this plays out. Like, just all this stuff is like, yeah, there's just so much involved in it, from consumer psychology to, things that are happening in government that are going to impact certain things. And yeah, just a lot of moving parts right now.
Another factor that we didn't talk about that I think will be notable is that if we're seeing the market start to correct a little bit, now people that are in an existing home won't have as much equity to do that move up. So the last decade, you buy a house, you're in it for 2 or 3 years, you build up a bunch of equity because the market's going up, you cash that out, and you go to the next one, and that allows people to just keep going and growing up to a larger home or more expensive home or a better location every 2 or 3 years. Not sure that that's going to continue because I don't think we're going to see those big bumps in equity every time. That may change the market up a little bit.
Yeah. Another thing too, I was actually just talking to a buddy of mine about the insurance market and how, homeowners insurance could be playing a role in some of this too, because
Yep.
homeowners insurance used to be more of a fixed amount that you would pay based on, your home and everything. And here in the Midwest, we've had, there's a lot of storm damage that happens with hail and wind and things like that. And, a lot of the model that these insurance carriers are going to is more of a percentage of price of your home, which is a significant increase. You could have an annual premium of maybe $1,500 or $2,000 on a, $300,000 home that now bumps way up to, 3, 4x whatever, you were paying previously. And so now, if insurance premiums are going to be based off of the, value of a home, going forward, that also is going to be have a bigger factor on people upsizing to, nicer homes and everything like that. Anyway, I hadn't heard that before, so that was kind of interesting to me.
It is a factor. We see this in commercial too, but definitely a factor. I think at some point, people just get used to it. They just adapt. But I think in the near term, as you're seeing those increases are still stinging, and I think it's going to be a factor.
Yeah. Well, cool. That brings us to the end of the show. All three headlines. Anything else you want to add? Any closing thoughts?
I'm just having a great time checking the news, watching all this stuff happen. So much going on in real estate and in politics, and they're all interwoven and coming together. So I think we say this all the time. This is a fantastic time to be alive and be doing what we're doing. So I'm really excited about what's going to take place over the next few months.
Yeah, likewise. So thanks everybody for tuning in. And as always, if there's any topics you want us to cover on the show that we haven't been covering, in the description right below this video. Well, if you're listening on a podcasting platform, in the description below this episode, you'll see a link there where you can text us your thoughts. So whether it's just giving us feedback on the show or you want us to cover a certain topic on industry news, definitely give us your feedback. We love to hear it. And with that said, we will come to a close and we will talk to you guys next week. Thank you.